Today, we're going to dive into one of the most famous formulas in all the finance. It's a Nobel-winning equation that completely changed the game. But we're not just here for a dry history lesson. Nope. We're going to uncover a hidden signal that's buried deep inside of it, a single number that some researchers call the market's premium for fear.
So, let's start with a really simple question. What if you could actually put a number on the market's collective anxiety? I mean, a real number that tells us not just how investors are feeling right now, but maybe, just maybe, where the market is headed next. That's exactly what we're going to explore.
But before we can get to that number, we have to start with the foundation. The whole idea rests on this one concept, variance, or as we call it in finance, volatility. Trust me, it's the engine that drives everything else we're about to talk about.
So what is it really? Well, put simply, variance just measures how spread out things are. When we talk about a stock's volatility, we're really talking about the variance of its returns. Is the price just kind of hanging out near its average, or is it swinging wildly all over the place? That wildness, that's variance.
You know, I love this quote from the football coach Lou Holtz because it perfectly captures a huge statistical idea that's tied to variance, regression to the mean. It just means that extreme results, whether they're amazingly good or terribly bad, they have this powerful tendency to snap back toward the average over time.
And check this out. This is the idea in action. Take the Australian cricket captain Michael Clarke back in 2012. The guy had a season that was just unbelievable. So was he suddenly twice the player he'd always been? No, of course not. He just had an incredible run of positive variance. And sure enough, the very next year, gravity kicked in, and he was pulled right back to his long-term average. And guess what? Markets do this all the time.
Okay, so knowing that things tend to snap back to an average is useful. But here's where it gets really interesting. What if we could know what the market expects to happen in the future? What's its best guess for tomorrow's volatility?
And that brings us to something called implied volatility, or just IV. Think of it like the market's collective gut feeling, or maybe it's collective anxiety, all baked into the price of options. It's not a fact, it's a forecast. When IV is high, the market is basically bracing for impact, betting on big price swings ahead. When it's low, it's expecting calm seas.
So where does this number even come from? Well, this is where the legendary Black-Scholes model steps in. Now, the formula was originally designed to figure out the theoretical price of an option, but here's the really clever part. We can run it backwards. If we already know what an option is actually selling for on the market, we can plug that price in and solve for the one missing piece of the puzzle, the volatility the market must be implying to get to that price.
Now this is absolutely crucial. The Black-Scholes model is a work of genius, but it assumes a perfect, tidy world. A world with constant volatility and no sudden, stomach-churning crashes. We all know the real world is, well, it's a lot messier than that, right? And it's right there, in that gap between the perfect model and our messy reality, that our real story kicks off.
So, let's flip the coin. We've just seen the market's forecast for the future, but what about the cold, hard facts of the past? What actually happened? This is what we call realized volatility. It's not a guess, it's not a prediction, it's the history book. We can just look at a stock's price movements over the last month and calculate, as a matter of fact, exactly how volatile it really was.
This slide just lays it out so clearly. Implied volatility, that's the weather forecast, the market's best guess of what's coming. Realized volatility, that's the actual weather that happened, what we can measure by looking out the window. One is an expectation, the other is reality.
So we have the forecast and we have the reality. You'd think, hey, they should probably be pretty close, right? But what if they aren't? What if the forecast is consistently and systematically different from what actually happens? Well, that difference, that turns out to be everything.
This difference actually has a name, the variance risk premium, or VRP for short. And the math couldn't be easier. It's just the forecast, our implied volatility, minus the reality, our realized volatility. That's it.
So why is there this gap? This quote just hits the nail on the head. Implied volatility is almost always higher than the volatility that actually happens. And why is that? Because investors are scared. They're willing to pay extra for protection. They buy options as a form of insurance against the potential market crash, and that drives up the price, and with it, the implied volatility.
And listen, this isn't just a one-off thing. It's not a fluke. Research from the Federal Reserve confirms that this gap between what the market fears might happen and what actually happens is almost always positive. It's a systematic premium that investors demand for being willing to bear uncertainty.
It is, quite literally, the price of risk.
Okay, so there's this consistent premium for risk. That's cool. It's an interesting little market quirk. But here's where it goes from just an academic curiosity to a potentially powerful predictive tool. What if this premium could actually tell us something about future market returns?
A huge landmark paper found something that just blew people away. Get this, between 1990 and 2005, the variance risk premium, this one little number, could, by itself, explain over 15% of the variation in stock market returns in the next quarter. Now, I know 15% might not sound like a lot, but in the world of financial forecasting where most things explain basically nothing, 15% is like finding a unicorn. It's huge.
Let's actually put that into perspective. This chart compares the VRP's predictive power to a classic that everyone knows, the price-to-earnings ratio. For predicting quarterly returns, well, it's not even a fair fight. The VRP is nearly 3 times more powerful.
And wait, it gets even better. Check this out. When you combine the VRP with the PE ratio, their joint predictive power jumps to over 25%. This tells us they're measuring 2 totally different things. The PE ratio is measuring valuation. Is the market cheap or expensive? But the VRP, it's measuring something emotional. It's measuring the level of risk and fear.
So let's just pull all this together. We have this statistical measure born from the gap between a perfect theoretical model and our messy market reality. But what does it really represent in simple human terms?
This is the final question we need to answer. What is this number truly telling us? It's fear. Plain and simple. The variance risk premium is basically a fear gauge. It's the extra price investors are willing to pay for insurance against the one thing they dread most, a sudden catastrophic market crash, what the academics call jump tail risk. When this premium is high, fear is high. When it's low, complacency is ruling the day. And that leaves us with a fascinating final thought. A perfect theoretical model met our messy human reality, and the gap between them created a number that actually tracks our collective fear. So if we really can put a price tag on fear, what does that tell us about the deep, emotional, and maybe even predictable machinery of the market itself?